Today, we are witnessing a potential turning point in the history of the Federal Reserve. President Donald Trump has nominated a former Federal Reserve official as the next chair of the Fed. This decision immediately captured the attention of global financial markets. The Federal Reserve is not just another government agency. It is the most powerful monetary institution in the world. Its decisions affect interest rates, inflation, employment, and global capital flows. A change in Fed leadership always matters, but this nomination carries deeper political and economic implications. According to analysts at AINVEST, this nominee represents a balanced stance. He is less dovish than Kevin Hassett. He is more moderate than Christopher Waller. This places him in a rare middle ground within the Fed spectrum. Fortune reports that markets view him as an independent candidate. Independence is the single most important word in this story. The credibility of the Federal Reserve depends on it. Donald Trump has never hidden his dissatisfaction with the Federal Reserve. During his presidency, he openly criticized Fed policy. He repeatedly argued that interest rates were too high. He believed monetary tightening slowed economic growth. Trump often framed the Fed as an obstacle to prosperity. This created unprecedented tension between the White House and the Fed. Historically, presidents criticized the Fed quietly. Trump criticized the Fed publicly and aggressively. This reshaped public perception of central bank independence. Many investors feared political interference. Others believed Trump was voicing long-suppressed frustrations. The nomination of a new Fed chair revives these concerns. Is Trump trying to control the Fed, or is he trying to reform it? The answer matters deeply for markets. The nominee is a former Federal Reserve official. He understands the institution from the inside. He knows how policy decisions are made. He understands the limits of political pressure. According to Fortune, he is not viewed as a political loyalist. Markets see him as intellectually independent. He has a reputation for analytical discipline. He prioritizes data over ideology. He is skeptical of short-term political demands. This skepticism reassures institutional investors. It also complicates Trump's narrative. Trump did not choose a radical. He did not choose a pure dove. He did not choose a hardline hawk. He chose a stabilizer. Monetary policy operates on a spectrum. Doves prioritize growth and employment. Hawks prioritize inflation control and price stability. Kevin Hassett is often seen as growth-oriented. Christopher Waller is viewed as inflation-focused. The nominee sits between these two poles. This balance is extremely difficult to maintain. It requires political courage. It requires institutional credibility. It requires market trust. A balanced Fed chair must disappoint everyone equally. That is often the sign of effective policy. Markets initially struggle with moderation. Extremes are easier to price in. Balance introduces uncertainty. Inflation remains the defining challenge of the decade. Americans feel inflation every day. Grocery prices matter more than policy speeches. Rent inflation shapes political outcomes. Wage growth interacts with price stability. The nominee is known to be tough on inflation. He does not view inflation as transitory. He believes credibility must be preserved. Once inflation expectations break, trust collapses. This belief aligns with traditional Fed doctrine. It reassures bond markets. It supports long-term dollar stability. It may delay rate cuts. That delay could slow growth. But it may prevent future crises. Political pressure on the Fed is not new. What is new is its visibility. Social media amplifies every disagreement. Markets react in real time. Fortune notes the nominee is skeptical of political influence. This skepticism is critical. Without independence, the Fed loses credibility. Without credibility, inflation accelerates. Investors demand higher risk premiums. Borrowing costs rise. Growth slows. The nominee understands this chain reaction. He has publicly warned against politicized monetary policy. That warning carries weight. It signals institutional continuity. Markets did not panic after the nomination. Markets did not celebrate excessively either. This neutral response is telling. Investors are waiting for confirmation. Words matter less than actions. The first policy signals will be critical. Bond yields will respond first. The dollar will follow. Equity markets will reassess valuations. Gold will react to uncertainty. A disciplined Fed chair supports dollar strength. Higher credibility attracts global capital. The dollar remains the world's reserve currency. That status depends on trust. Trust depends on policy consistency. A politically neutral Fed reinforces dollar dominance. Short-term volatility is likely. Long-term stability is possible. Currency markets favor predictability. The nominee understands this deeply. Gold thrives on uncertainty. Political tension between the Fed and White House boosts demand. If independence is preserved, gold stabilizes. If independence erodes, gold rallies. Investors hedge against policy risk. The nomination alone creates uncertainty. Confirmation hearings will add more. Policy speeches will matter enormously. Gold reacts to credibility gaps. That dynamic is already visible. Equity markets dislike ambiguity, but they fear inflation more. A balanced Fed chair creates sector rotation. Growth stocks face valuation pressure. Value stocks may benefit. Financials react to rate expectations. Technology reacts to discount rates. Energy reacts to inflation expectations. Market leadership may shift. Volatility may increase. Is the Fed moving closer to the White House? Or is the White House adapting to the Fed? This is the central question. Trump's choice suggests strategic calculation. He did not choose confrontation. He chose controlled alignment. That may calm markets temporarily. Long-term outcomes remain uncertain. Power dynamics evolve slowly. Institutions resist sudden change. Scenario 1. The Fed remains fully independent. Inflation gradually declines. Growth slows but stabilizes. Markets regain confidence. Scenario 2. Subtle political influence emerges. Rate cuts come earlier. Inflation risks rise. Gold and commodities surge. Scenario 3. Institutional conflict escalates. Market volatility explodes. Past Fed chairs face similar pressures. Paul Volcker chose credibility over growth. Alan Greenspan balanced markets and politics. Jerome Powell defended independence publicly. History rewards discipline. Markets remember mistakes longer than successes. The nominee is aware of this history. He studies it closely. He references it often. That matters. Watch inflation data. Watch wage growth. Watch Fed meeting language. Watch dissent within the FOMC. Watch Treasury yields. Watch the dollar index. Watch gold prices. Watch political rhetoric. All signals matter. None act alone. Media narratives simplify complex decisions. Reality is more nuanced. The Fed operates with long lags. Policy effects take time. Headlines move faster than fundamentals. Investors must separate noise from signal. This nomination is not an immediate revolution. It is a gradual shift. Gradual shifts reshape systems. Slowly, then suddenly. This nomination is not just political. It is institutional. It is historical. It reflects changing attitudes towards central banking. It reflects public frustration with inflation. It reflects political recalibration. The Fed stands at a crossroads. Independence remains its greatest asset. Credibility remains its strongest defense. The nominee embodies that tension. The world is watching the Federal Reserve. Markets are listening carefully. Every word will be parsed. Every decision will be analyzed. This Fed chair nomination matters globally. It matters to households. It matters to investors. It matters to America's role in the world. The balance between power and independence is fragile, and history will judge how it is preserved.